So a P&L that says you have $246,000 of profit. Your bank account shows you grew $18,300. Where in the heck did the other $227,700 go? Here we are, Chad Boyle, CPA. I am here with Corey Boyle.
I'm here.
Technology extraordinaire. And we are talking about where did the money go? We will detail that out to the penny. Those numbers are a composite of the landscapers we work with. The ratios are all real. That isn't a mistake, and it isn't bad bookkeeping. It happens to good businesses. There is an exact answer, and we are going to find every dollar, every penny of it. So a company you would recognize. Here's the company. Revenue last year, $2.4 million. They got 3 crews, 14 employees, 1 person in the office doing install work. They have a maintenance book underneath it. The year before that, they did 1.8. That's awesome growth. These are a composite of the landscapers we work with. It's not just one company. So last year, 2.4. Year before that, 1.8. Grew 33%. I love it. 33% revenue growth in 1 year. Hold on to this one. Now watch the percentages, not the dollars. 633,000 of labor tells you nothing, but 26% tells you everything. So here's the P&L. You got the revenue, direct labor. There's your 26%, 633. Your materials, subcontractors. I'm not just going to read that. I know you guys can read. Net profit, 246, 10%. Gross margin, 50%. That's right, where a landscaper should be. Net profit, 10% for this business. That's a good year. It's not a great year, but it is a good year. We're celebrating 10%. There's nothing on that P&L that needs fixing necessarily. Now let's go look at the bank account. Here's the profit versus the bank. So remember, the net profit was 246. But here's what the bank said. At the beginning of the year, they had 61.9. End of the year, 80,200. So the bank account grew 18,300 when their net profit was $246,000. So that 227,700, that profit that never became cash, what happened to that? There it is. Big number. That's the number we need to reconcile. So here's the 6 places that went, all to 27,700. Number 1, you did the work, but you haven't gotten paid yet. So 86.2 is money that was owed to you for work that you completed last year. All right, great. So a year ago, they were owed 260.99. Now they're owed that number, same 52-day wait, bigger business. Number 2, the work you finished, but in this case, you haven't invoiced them. What the heck you waiting for? Get those invoices over there. 31.5, work done, not yet billed. Number 3, loan principal, what you paid back on what you borrowed. So let's call that 71.3. You paid that down on truck and equipment loans. Your P&L shows the interest. It never shows the principal, but the bank, both of those components run through the bank account. Number 4, the equipment that you bought and you paid for outright, you didn't borrow money to bring it on. So $18,000 you paid for it in cash. Number 5, the tax money you already sent out. So you were a good citizen and you paid those taxes, 61.3, in order to, on April 15th. And that is what that number is. Number 6 is what you took out of the business on top of your salary, 27,800. So those are owner draws, distributions, dividends, whatever you want to call them. You took money out of the business that wasn't in your payroll. It was a distribution of profit. And you should be an S Corp and you should be doing that. It saves you in taxes. So 296,100 cash out across all 6 of those items. But wait, the gap was 227,700. So that means something went in our favor. We like that. It went the other way and offset it. And that one thing that put cash back, that was an expense in the P&L that never touched your bank account. So it was a non-cash expense. And that's called depreciation. So it's a real expense. It's an economic expense, represents the cost of the fixed assets you need to run your business, but it is non-cash. So 68.4 was the year depreciation expense, and it was no cash impact. So you bought the trucks in earlier years, and the P&L spreads that cost out over the life of the trucks, which is going to span multiple years. Your bank account already paid for it. So subtract it to get to profit, and you add it back to get cash. So here is the view, and I love waterfall charts. So this is a great pictorial. Is that a word? It sounded good, but anyway.
It is now. If it wasn't, it is now.
We did it. We did it. Not only did we bridge the gap of where the 227,700. So here it is. So the net profit we talked about, 246, that's on the left. What the increase of cash in your bank account, 18,300, that's on the right. And the math in between of how we got there. So we had that depreciation. Again, that reduced our profit, but there was no impact to cash. So we got to add that back. And then we have all these items that were cash impacts that weren't in our P&L. So we had money that is accounts receivable that's owed to us, work that we haven't billed yet, loan principal. So we paid down principal on a loan, and then we bought equipment. We sent the tax man his money. Boo, nobody likes that. And the distributions, 27.8. So those are the items and why it's the net profit is different from the increase in cash. And so you might see this and say, red, that it looks bad, but I mean, those items aren't necessarily bad, right? They just are. I mean, you got like, if we just look at the red bars, I mean, you have two of them there it's money that is owed to you. So you've work that you completed and you either need to collect it or bill for it and collect it. So it's just a difference in timing of when that revenue was in the P&L versus when you actually collect the cash. So I wouldn't say it's a bad thing, but it's just a thing. Loan principal. So your 71.3 went to that. So you've paid down your debt. Eventually that's going to go away. And then what's going to happen is that 71.3 is all else being equal, your cash in your bank's going to go up by 71.3. So again, you made a decision to purchase equipment using a loan that helped you drive that $246,000 in net profit. So again, I call these are things, and I think they're good things. Then you bought equipment. Again, that's going to help you drive more net profit. So a good thing. And then the taxes, we want you to stay out of jail. So again, I call that a good thing that you paid that. And then owner draws, like, you work hard. You should take money out of your business. And this shows that you can take money out of your business. So again, we see red. It's just an item. I think they're all good things. This is a great business. So kind of summarize here, what is actually wrong in this picture? And before I answer that, let me rule out what everyone guesses. And that maybe it's the debt. Again, is that a bad thing? And the answer here, if you look at that 3.45x, what that means is that you're comfortably able to cover your loan payments with the profit that your business makes. So again, that's not a problem. The debt isn't a problem. It's covered 3.5 times over. So nothing about this business is broken. This is a good business. It grew 33%, and the growth ate every dollar of the profit. Growth eats cash before it produces it. So every new job needs materials, payroll, fuel up front, and the customers, sometimes they're going to pay you later. Nope, nobody told you that because your P&L can't show it and your bank balance can't explain it. But we explained it. So how big is your gap? That might be the question you're asking. Two things to decide how big your gap is, and a third decides whether it hurts. How fast you grew determines how big the gap is and how long you wait to get paid. So this is just a way to show like days to get paid. It's a metric you can use to manage your business. Just shows how many days outstanding or it takes for you to collect your receivables. So across landscapers we work with, this runs about 45 to 60 days. I mean, past that, you're funding your customer and maybe you have a process issue on your receivables. How much cash you are holding when this happens. So cash in the bank divided by fixed overhead just shows you kind of what the cushion is. 2 to 3 months is the target. So ideally you'd have about 124 to 186,000 when compared to 61,000 of fixed overhead costs. 2 to 3 months is the target, 124, and they have 80. So obviously some opportunity there. So those three numbers, how fast did you grow? 33%, days to get paid, 52, months of cash, 1.3. Hey, these are just metrics that can help you give you the visibility you need into what's going on in your business so that you can make decisions if you want to change things. So the fix is not more profit. This business made plenty of profit. The fix is to see it before it happens. My books get done every month. Wouldn't I already know this? That may be a question you're asking yourself. Your books record what happened. Nobody turns them into that chart unless it's somebody's job. So there's a report that shows all of this, and it's called the Statement of Cash Flows, and nobody has ever opened it. But you should. You can do this yourself, and almost nobody does. The business takes every hour you have. Your profit tells you how the year went. It does not tell you where the money went. 3 numbers you can find this week, 6 that take a real set of books. So where did your cash go last year? We'll build that exact profit picture on your business and hand you 6 numbers along with that fancy old waterfall chart. So if you're interested in that, book a free profit and cash flow analysis. Link is in the description.